Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is investing in dividend stocks. And this morning I was taking a look at our example paper money portfolio, and it occurred to me that the markets have been fabulous, but not everybody has been participating to the same extent. And it can be frustrating when we see the markets rocketing upward, and yet we're not fully participating in that advance. So today I wanted to talk through one number, one metric that may explain why a portfolio is falling behind. So I think this is going to be an interesting discussion. Of course, we're going to include dividends in that discussion. A lot to cover, but before we get to that, though, let me first of all say hello to everybody who's chatting in. Great to see all the familiar names. Great to see anybody who's new here. But hello there, Ricebird and Lawrence, Robert, Eva, JDLMI. We have Sam and Greg and Rojo. Everybody else, thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you do happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us here in the live stream, be a part of our live audience. This is a Thursday webcast series, and we kick things off promptly noon Eastern time. Now, I also want to let you know that my very good friend Brent Moore is going to be hanging out in the chats. He's going to be addressing any questions that come in through the YouTube chat function that I can't get to. Brent and I have been working together now for, this is our 22nd year, I think, Brent, working together. So yeah, Brent brings a ton of experience to this discussion. I've been at it into my 22nd year. Brent's got about 5 years on me. So thanks for having my back there, Brent. Brent and I would also like to issue an invitation to everybody watching, whether live or on the archive, to follow your favorite Schwab presenters on social media. You can find and follow us on X or on LinkedIn. So you can find Brent on X. Just go to @BrentMooreCS. That's his handle there. You can find and follow me there @CameronMayCS. Or you can find us on LinkedIn. Just go to linkedin.com/in. And for me, that's Cameron May CS, actually /Cameron May CS. I'm sure Brent is /Brent Moores. You can correct me, Brent, if I'm wrong. In any case, let's get into this discussion. And as we do, of course, we need to consider the risks associated with trading or investing. Bear these important disclosures in mind. This material is intended for general informational and educational purposes only. There are risks associated with investing in dividend-paying stocks, including, but not limited to, the risk that stocks may reduce or stop paying dividends. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and diversification does not ensure a profit, does not protect against losses in declining markets. Okay, so let's set an agenda for today's discussion. As I mentioned, we're going to be talking about the one number that may explain why a portfolio is falling behind. But before we get to that, I do want to take a quick look at what's going on with the markets in general. So we're going to look at the dividend market. We're going to look at the competition. Then we're going to look at our current portfolio and see how it's performing. And I want to put its performance in context with what, let's say, the average investor, if that's represented by, let's just use the S&P 500 as a stand-in. Let's see how we're doing. And then we're going to talk about, if a portfolio is falling behind, what might explain the falling behind? Because it is not fun to be sitting there on the curb and watching the party advance without you, right? So let's go right to the Thinkorswim desktop platform, and let's have a look at, I'm going to start with TNX:CGI. If you're not familiar with this symbol, this is a chart of the average yield of a 10-year treasury. And those yields have been going up and up and up, although recently, and now I put a line on here, because this is basically going back 4 weeks. I've been on sabbatical for 4 weeks. I'm just getting back into the swing of things. So I wanted to get an update with where we were and where we are now. Now, why do we care about what's going on with bonds if we're not talking about bonds? We're talking about dividend stocks. Well, for some, they consider the bond market to be sort of a competition, a competitor for the dividend stock market. Because if an income investor is looking for somewhere to put their money, maybe they put it in bonds if they look attractive. Maybe they put them in dividend stocks if they decide they look attractive. And bond yields going up and up and up and up may have been attracting more income investor attention away from stocks and putting pressure on stock prices. It's not the only potential variable in how stock prices perform, but it's interesting that as yields have come down over these last 4 weeks, What's been going on with dividend portfolios? Now, I'm going to use a representative, an index. This isn't going to be a perfect reflection of every dividend portfolio out there, but there's a symbol that we use. I pronounce it, this is just me, because it looks like this to me. It's a big, long, awkward symbol, dollar sign, SPHYDMUT, SPHYDMUT. What is that? That is the S&P 500 Dividend Monarchs Index total return. So this is a portfolio, an example portfolio of all the companies from the S&P 1500 who have been increasing their dividends on an annual basis every year for at least the last 50 years. That's who these companies are. So this is a reflection of how their prices are doing, but also building in the dividends that have been paid. So look at the last 4 weeks here. As bond yields have been coming down, maybe the competitor is struggling a little bit. We see dividend investors represented at least by a Dividend Monarchs Index actually starting to really do well. So that might be nice to see, particularly since our portfolio consists exclusively of dividend stocks. So that's nice. Little update. Not everybody cares about the day-to-day, week-to-week, month-to-month fluctuations when we have a long-term investment horizon. This is not a webcast about trading. It's about investing. But I do like to provide that sort of a context. So let's go look at how our portfolio is actually doing. Okay, so we go to our monitor tab. Let's just quickly revisit what we have. We have 13 positions. So we have an example $200,000 portfolio that we're managing here. We're allocating 5% to each stock. So that's going to allow us to do up to 20 positions. So we can kind of spread things out, pursuing a little diversification. As you noted here, diversification is not a guarantee of protection as we go down, if we go down. But we have 13 stocks. We're going to build that up to at least 20. I may just add more money to the portfolio and keep building after that, because I want to have something new to continue talking about, not just talking about the same stocks. But we have those across a range right now of 8 of the 11 sectors. I tallied these up this morning. We have 2 each in staples, utilities, financials, real estate, and healthcare. We have 1 each in energy, materials, and industrials, and we're not going to go beyond a concentration of more than 2 in each one. All right, so if we have 11 sectors and we're only going to wind up buying 20 stocks, let's put 2 here, 2 there, 2 there, 2 there, and so on. All right. So we're not going to be adding to staples, utilities, financials, real estate, or healthcare today. There's room for the other 6 sectors, though. We can also see when these companies pay dividends. We can see the dividend frequency here. We can see the dividend yield. Right now, our average yield is about 3.4%. That's set against the average yield of an S&P 500 paying company. About 1.1% is an average right now. I'm going to skip over this number, hint, hint, spoiler alert, and move over here to our dividend payout ratio. This is the percentage of earnings that are being paid out in dividends. For some investors, if they see a very high dividend payout ratio, if it stays high, they might see that as a threat to ongoing dividends. Because if every dollar the company makes is going out to shareholders in the form of dividends, doesn't leave much for operations in the long term. Then you got to lean on debt and other things like that. Speaking of debt, here's our long-term debt figure. And as long-term debt climbs, if it's sustained for a long period, again, that might be seen as a threat to ongoing dividend collection. So we're keeping an eye on that. We have our trade price and our current market price here. But here's a number I wanted to look at today in a little more depth. Sam, you say KMI is worth a look. We already do have a position in KMI. Yep. So we're not going to be adding that to our portfolio today. But how's our portfolio doing overall? Right now, we're up about 5.13%. Now, this was a portfolio that we started building in January. So let's go see what's been going on with the S&P 500 since January. And let's look at that. So here's January. There's the changeover from December of last year to January of this year. And let's look at how far we've come since then. So let's pull this right up to the current day. And as you look at that little pop-up box right next to my line, it says 9.32%. It's a plus 9.32%. The S&P 500 is up 9.32%. I'm sorry, what was our portfolio up? Let's go back here, 5.16%. Wait a second, we're way behind the S&P 500. That's a failure, isn't it? Maybe not. We need to explore that a little bit more, okay? So I want to investigate that numbers. Now, for each portfolio, there are going to be different reasons. For this one, there's certainly some that we need to acknowledge. Number one is we just started building this in January. Target is actually the first thing we bought. It's up 21.5%. So we've owned that since January 8th. I can just click on the quantity here and it shows we purchased that January 8th of 2026. AbbVie is the most recently acquired. We bought this right before I went on sabbatical. So this was purchased on May 14th. We've only owned this thing for a month. So obviously, all of that fun that bullish investors had with the S&P 500 from January until May 14th, this $10,000, we didn't get to participate in because we didn't own AbbVie. That's how much we put in each stock. That's why I say $10,000. So actually, on average, we've only been invested for a little bit more than 3 months in these stocks. So when we look at this, to be up 5.2-ish% in just a shade over 3 months is pretty close to essentially being on pace with the S&P. So I think that's important context. So when an investor is examining their portfolio, we can't beat ourselves up for not making the same amount for a different time frame than we've been invested. A long snapper said, oh, you're talking to somebody else. Okay. Anyway, another thing that is not reflected in a paper money simulated trading environment are the returns on our dividends. Now, that's a big deal for this portfolio. We're earning, on average right now, as of today's prices, 3.4% annual yield. So 3.4%, you might think, so do we just take 5.2 and add in the 3.4%? No, it can't do that because we haven't owned these stocks for a whole year and collected the whole 3.4%. We've gotten a quarter of that-ish. I'm kind of rounding a little bit. So that's maybe another 0.8% that we can add here. It's just not reflected in the portfolio because nobody's paying dividends to fake accounts. So we can't reflect it here. It doesn't happen. So really, the portfolio overall is probably up on the order of about 6% in basically the 3-ish months that we've been managing it. So not too bad. I would say that's okay. That's if it's not keeping pace with the S&P 500, and I think it is. I think it's actually exceeding it a little bit. It's right in that range. But sometimes the fact is portfolios just lag, and there are no other excuses, or there's no other excuse that seems to bubble right to the surface. So I want to talk about this number that we skipped right here, beta. Now, we've got 144 people watching. We got 12 dozen people watching right now. And I'm sure that there are going to be hundreds or thousands more that watch this video later. So not everybody knows exactly what beta is. What is beta? Well, for some, they see it as a measure of risk. But another way to think about it is it's each stock's relationship, its historical relationship with how it behaves with the S&P 500. So what we tend to do as investors, I think that this is natural, is we'll look at the S&P 500 as sort of our own portfolio, even if we don't own it. And we say, oh, the S&P was up 1% today. The markets are up 1% today. I must be up about 1% in my portfolio and we get on with the day. But sometimes we go look at the portfolio and we're not actually up 1%. We're up 0.5%, or sometimes we might be up more than 1.5%, or more than 1%. Anyway, but this beta, what it does is it on a stock-by-stock basis, it looks at how that stock performs, typically compared to the S&P 500. So two things that we need to keep in mind when looking at beta. Number one, is it positive? That means that there's a positive correlation over the last 5 years with the S&P 500 in that stock. And then the other thing is the number. Think of that in percentage terms. If we have a beta value of 1, what that's telling us is over the last 5 years, as the S&P has moved, our stock has tended to move just about the same amount. Not always exactly the same amount at the same time, but on average. So if the S&P goes up 1% on a given day, our stock might go up on average about 1% on that same day. Or I have to keep throwing in on average. It doesn't happen every time. If the S&P goes down 1%, our stock might go down about 1%-ish. So it has kind of a 1-to-1 relationship, or a beta score of 1. What you'll notice about our stocks in our portfolio is none of them have a score of 1. They're actually all below 1. Now, Target is the closest. It's at 99. So let's look at, I'm going to look at NEE here. So let's look at NextEra Energy. And it has a beta score of 67. What does that mean? Well, what that means is that if the S&P goes up 1%, how much might an NEE investor think their stock is likely to go up at the same time? About 0.67%. So in other words, it goes up a little bit, it goes up in the same direction, but just a little bit less on average. Now, that can be gauged as a measure of risk or volatility, because if the S&P goes down, it will tend to go down less. So that number is very important. And I picked NEE for a very specific reason. I just spotted this just now because this number changes frequently. You'll see it move around a little bit. Well, not necessarily this one, but some of these will change as we're talking. But our average beta across the 13 stocks that we own is actually 0.67. So let me ask you a question. Let's say the S&P 500 goes up 1% today, closes day up 1%. How much might we expect this portfolio to be up approximately? Again, it's not exact every day. It's just an estimate based on what the stocks have done in the past, what we think they might do in the future, right? So if the S&P goes up 1% on average, our portfolio, it might be up about 0.67%, or about 2/3 as much. Yeah, you have exactly, once again, about 0.67. Yep, so for a dividend investor, what that can tell us is, oh, okay, so our portfolio is less volatile than the S&P 500. If the S&P is shooting up, we go up, just not as much. If the S&P starts really cratering back, we'll tend to fall, but just not as much. Again, it's all an estimate. It's not a guarantee. But historically, that's how this portfolio has behaved. So let's talk about what this investor might think may be coming if the S&P goes for a great run. Here's a mistake that's commonly made. An investor carefully assembles a portfolio, carefully looking for low beta stocks because they don't like volatility, and then the S&P starts racing up, and then they look at their portfolio after a year or 2 or 3, and they're disappointed because their returns aren't as great. And what they may have been hoping for is that their portfolio, which they designed to have low volatility, captures all the upside, maybe more, and doesn't experience a downside. That's not really the way this works. Okay? Volatility, lowering the volatility of a portfolio tends to, again, doesn't guarantee to, but tends to reduce the downside volatility, but also reduce that upside potential, at least in percentage terms. That's a really important number if an investor is getting frustrated because they feel like they're getting left on the curb, left in the dust by the rest of the markets. So if you weren't familiar with beta, maybe this is one that could be explaining some underperformance out there. Is it guaranteed to be the reason? Nope. We've looked at some other reasons here. But I think that's going to remain on our screen so that we can see that. So what we're going to be doing today with our new position is just dialing that beta up a little bit. Does that mean I'm going to go out and find something that's 2 or 3 times as volatile as the S&P 500? Nope. It might just be that we're looking for something that's at least roughly equivalent to the S&P, or has been over the last 5-ish years on average. So Sam says, you asked your portfolio where's beta, response was not found. I don't know exactly what you mean there, Sam, but the way that we add this here on Thinkorswim is you go a little gear icon right here, and here are the columns that we currently have. And if we don't have beta, we can look for it right there and add it, okay? Just select it, add it. You can add it here. You can remove any of them that you don't want right here. So let's go build out our portfolio a little bit more, but we're going to do this while keeping volatility in mind. We're going to dial up. So one thing that we're not going to do is add another stock that's at 0.67 or lower. Let's put ourselves in the shoes of that investor who's willing to take a little greater risk, dial up that volatility, trying to dial up the future potential of their portfolio. So how do we do that? Well, first of all, we need to know our priority. We're not just going to go find some volatile stock that happens to be paying a dividend. That may be a couple of priorities, but we do have a little bit more extensive list of example priorities for this for this webcast series. So number one, yes, is yield. Number two, and bear with me, I don't like to miss anything, so I always put this in my notes. We do emphasize diversification for this example portfolio. Not everybody likes diversification. Diversification can have a tendency to dampen volatility in a portfolio, but also it may limit growth to some extent. If somebody's a really gifted stock picker, diversification may not be what they're looking for. Anyway, Long Snapper says higher yield, please. We'll definitely include that. Yeah, we're going to look for yield. Right now, our average yield's 3 times the average of the S&P 500. So yeah, we have been emphasizing that. We are going to look for consistency in dividend payments. So we'll check the chart for that. We'll keep an eye on debt. Will be volatility, of course. We just had that discussion. Is going to be something that we look for in the stock. We're going to look for a net performance number, not just does it pay dividends, but also over a long period of time, what has the stock done? And I think you're going to be surprised by the one that I bring up today. I already have one in mind, but it's going to be different from the ones that we've seen before. And then finally, for some, this hasn't really been an emphasis for our discussions, but for some, they have a priority of the payment schedule. Here's what I mean by that. For some dividend investors, they very carefully select their stocks so that some are paying in January, some are paying in February, some are paying in March, and so they get sort of consistent payments. For others, they don't really care as long as they have what they consider to be a quality stock. If it pays in January, February, they'll do their budgeting and spread the money out afterward. So those are our priorities. Okay. How might we put that into the Thinkorswim scan function and find stocks that seem to fit those priorities? Let's go to our scan tab. And what I've done in a previous discussion is I created a scan. Let's load that scan up here. Okay, so we're going to go load scan query. We're going to go to our personal. I created something called the dividend working class. So here's the way that scan is built. It scans through the S&P 500. We could change that, look at something else, look at the Russell or something like that. But we're going to scan through the S&P 500. By default, this will exclude the dividend aristocrats because we have a different scan that can do that. Or if you're not familiar with the dividend aristocrats, they're basically S&P 500 companies meeting certain market capitalization requirements that have been increasing their dividends at least every year for the last 25 years. So we have a watch list of those, but does that mean that a company that hasn't been increasing a dividend every single year for the last 25 years is, let's say, a low quality candidate? Not necessarily. So we constructed this scan to look at the S&P 500 and look for things that aren't dividend aristocrats that maybe got overlooked. All right. Now, included in this scan, we look for yield, at least 2%. And let me, I don't know if I can quite minimize that. Anyway, let me pull this over a little bit more here so you can see our metrics. So yield between 2 and 6%, Low yields would be kind of against the purpose of this entire series. High yields may be seen by some investors as carrying extra risk. It's tough for a company to continue paying very high dividends without drawing down cash, without going to debt, that kind of a thing. Market capitalization, little tiny companies tend to have lots of volatility in their operations, and it can be tough for them to pay dividends conceptually over a long period of time. So we look for our example portfolio, a market capitalization of at least $10 billion. Beta is a consideration. We've set our minimum beta down at 0.5%, or just 0.5, I should say. And we set the max at 1.5. Now that we understand what that is, I'm going to tailor that. So right now, our portfolio beta is at 0.67. We're looking at, let's nudge that up. So it's not doing us any good to find something with a beta between 5 and let's say 0.7. How about we put our minimum now for this discussion at 0.8? So we're looking for stocks that are in the range of the same volatility as the S&P 500, or maybe even move faster up or down. And I always say up, which is great, or down. Yep, when we look for a higher beta stock, it can move up and enhance returns, but if we move down, it can also increase the risk in the portfolio. Long-term debt to capital. Sam, you're saying you're guessing less than 1. Well, we set that maximum at 50. So what that's doing is it's looking at long-term debt as a percentage of total capitalization, including common stock shares and preferred shares and long-term debt. Tally all that up, see how much of that consists of just long-term debt, and express that as a percentage. There we go. So we're going to set that as at a maximum of 50. So this is just an example scan for a dividend investor who is, okay, we're looking for a little bit stronger volatility, but still looking for maybe some of these other metrics that we've discussed in the past. There's one other thing I'm going to do here today. It doesn't do me any good to find the same stocks that we already own. We actually have a watch list over here called current dividend stocks. There are the 13 that we own right there. So I just maintain this. I just add one of these stocks. What this watch list allows us to do is we can quickly, look at their charts if we want to, but also we can exclude those from our scan. I'm going to open this back up to potentially looking at the dividend aristocrats, but I'm going to eliminate, let's exclude our current positions. There we go. So it's not going to just tell us, hey, Cameron, boy, you really ought to be looking at AbbVie right now. Not that it would be saying that anyway. It's just looking for what we want and finding it. But it's not going to show us AbbVie. It's not going to show us TGT. Sam's saying it could, we could build this out further if we wanted to. Yep. Now there's one thing that can happen very quickly when building a custom scan. Let's talk about what we've already added. We've already told it, don't show me every stock, just the ones in the S&P 500. And of those, let's cut out the 13 that we already own. Of the remaining 487-ish, let's only look at the ones with quite high yields. And of those, only the ones at least $10 billion. And of those, only the ones between 0.8 and 1.5 beta. And of those, only the ones that have their debt below 50% long-term debt to capital. As we layer on more and more requirements looking for, in the investor's mind, the perfect position, perfection may not exist. It's probably a bit of a myth. I don't know. Can't say that anything's perfect, right? Anything can go up or down in stock markets. But pretty soon we wind up with 0 results. And if I run this scan right now as currently constructed, let's see what we get. Looks like we have 29 stocks out of 500-ish. I say 500-ish because even though it's called the S&P 500, it could actually be a little bit above or a little bit below. What is it right now? I haven't looked recently. It's like 503. I don't know. Brent probably knows. But so what do we have here? Well, we got a range of stocks. I have these organized by dividend yield. You can just click on any of these column headings and have these arranged according to that investor's priorities. So I just have these arranged by dividend yield. Now, Best Buy is in consumer discretionary. I eliminated Best Buy from consideration for one reason, and that is over a long period of time, it's just been going down and down and down and down and down. Even with dividends being paid, it hasn't been enough. It could reverse. It could start coming back up again. International Paper is in the materials sector. We only have one stock in the materials sector. So that kind of fits in our portfolio preferences for diversification. We're trying to limit it to 2 stocks per sector. All right, so this is in consideration. It has a 5.2-ish dividend yield, 4.5 times average right now. Ex-dividend date just passed. That's okay. Timing dividend investments to try to capture a dividend like within the next week or two. Let me talk about that for just a moment, because doesn't it feel good to buy a dividend paying stock right before the dividend? Why don't we just do that every time? Well, that may reveal a little bit of a gap in our understanding of how dividend payments actually work. When a dividend goes when a dividend paying stock goes ex-dividend, it means, well, that's the date. If you buy it on that date or afterward, you don't get the dividend. If you buy it right before that, you get the dividend. Awesome. Except you're going to get the dividend. What happens to the share price? You bought it day before ex-dividend date. What happens on the ex-dividend date the next day? That share price is adjusted down by the amount of the dividend. So not really a strategy offering an advantage in one way or the other. It's really just over time, does the stock continue to appreciate? Does it continue to pay dividends? All right, so International Paper, though, I think is going to be the one that we're going to add to our portfolio today. It meets all of our metrics. We could add beta to these columns right here. We can come over here and add beta. There's another place we can check the beta. A little hidden place. So here's another question, another way to address your question there, Sam. If we want to see beta, we can go to the trade tab, just type in our symbol right here, IP, and right underneath that where it says underlying, we're pretty familiar with seeing the quote information, last price, the net change, the bid and the ask price, the volume numbers. But this little caret, if I click on that, it reveals another line of information. And right over here is the beta. So International Paper has a beta of 0.93. That's actually about 50% higher. Not exactly. It's probably more like 25%. 25% higher than our average for our portfolio. So this can help our portfolio volatility levels, our beta score, up a little bit. It's not going to make a huge impact. It's one of 14 positions, but that's going to be our stock. Now, there's something else I wanted to look at, though. Here's a final thing that we consider in this series for investing, and that is not that history is any guarantee of future results, but we do look at the history of the stock, because if a stock has just been going, IP has been coming down pretty much all year. It's been a good year for most stocks, not for IP. So why are we considering investing in it? Well, for some dividend investors, a couple things that might be accomplished when a stock goes down. Maybe it'll start going up again. That's a maybe, that's a question mark. But another thing it does is as price comes down, as long as they don't cut their dividends, it tends to increase the yield available. That's why it's probably a good explanation for why there's a 5.2% dividend available on International Paper right now. So, but we're going to look at this through a longer term lens. And I think this could be interesting. Let's switch this to a 10-year chart. Where is International Paper currently trading relative to where it's been over the last 10 years? Well, it's had this sort of cyclical behavior over the long term. These are years we're talking about, running up in big long cycles, each of these lasting about 4 years, which is kind of a typical longer term cycle, up and back and up and back. And if you look where we are right now, for some, even investors may look at a chart with that long-term horizon, try to gauge where does it seem to be. Right now, we seem to be at the low end of that range. Am I going to take that a step further and say, oh, that means that we're absolutely going back up to the high end? Nope, I don't know that. But I can say at least right now, we're on the low end of what investors have been paying for international paper over the last 10 years. And this chart doesn't even reflect the value that's been delivered in the form of dividends. So each of these little green icons you're seeing is a dividend that was paid. 46 cents, 46 cents, 46 cents. Oops, didn't mean to start drawing a line. Let me get rid of that. Let's go up here to the present day, 46 cents. I know they increased their dividend a little bit here and then cut it back. I think they cut it back right during one of these significant drops in price. That is a common time when a company might cut dividends, because as price falls, that dividend may grow proportionally, can get to be a little bit of a load for the company to continue to pay. Sam, thank you for the comment there. IP's manufacturing, huge rolls of stock paper. You've hauled some of it. Very good. I don't know. So by haul, I think you're referring to trucking. I'm from a trucking family. I actually have 6 brothers. There are 2 of us who are not truckers. So there's me and an artist. And the other 5, I said 6 brothers, so that's a total of 7. The other 5 are truckers. Yeah, so great. Anyway, let's add in these dividend payments to our chart. So what we can do is come up here to our little chart settings icon, the gear icon, go to equities. This is a stock or equity. And I'm going to change the chart to adjust. Let's change this from just adjusting the chart to reflect big unusual dividends, what we call special dividends. Let's show the impact of all dividends. Click apply, click OK. So what this is doing now is it's showing us over the last 10 years, what has stock price done plus all the dividends. So you'll see, instead of just being kind of flat, actually, it's been net increasing over time, still at the lower end of a big price move over the last couple of years. So we're going to be adding some international paper to our portfolio. Let's go to our trade tab. Looks like it's a 3773 stock. So let's take our $10,000. That's 5% of our $200,000 portfolio. Divide that by 3773, and let's see how many shares we can buy. 265 shares. So let's add those to our portfolio. No, I'm not going to be putting a stop on it. We don't do any of that for this. This is an investing discussion, not a trading discussion. But let's go to the ask price. Let's buy, I said 265 shares, didn't I? Yep, 265. And let's add $10,000 or 265 shares of IP to this portfolio. So I'm going to do this as a market order. We only have a couple of minutes left in this webcast. Obviously, if we switch this to the market order, that should be buying the 265 shares at the market price. When we put in a market order, there's a risk we're taking here. Price right now is $37.71. That's not guaranteed. We don't know exactly how much we're going to be paying. But the trade-off here is it increases the likelihood of a quick fill, which when the clock is ticking on the end of a webcast, that can be a good thing. So let's click confirm and send. Buying 265 shares of IP at the market price. There's not a commission on this investment, but there can be on some. But that'll have us right around our $10,000 if we buy it at current market prices or near. So let's send that order off and see what we get this filled for. There it is. Bought it. See that? Price went up a penny. We paid $2.65 more than we were thinking versus $37.73. All right. But guys, we are in. We have a new position in the materials sector. So that rounds out that sector's allocation in our portfolio. And we'll see how this can continue to perform. But this is a good example now of how IP, it's a brand new position. We can't look at the S&P 500, hope the IP has done that much for us because we've only been in it for literally seconds at this point. But beta can provide that context for those more mature portfolios that have been allocated for a good length of time, and we're wondering why we're falling behind. Well, maybe that was deliberate. Maybe we never intended to keep pace in the first place. All right, guys, but thanks for giving me your time and attention today. Hopefully this has been an insightful discussion for you. This is what we do on Thursdays. We invest in example dividend stocks. So hopefully you'll join me again next Thursday. As I let you go, I want to make you aware of some other resources, or just the full slate of resources that you have available to you from Schwab Education. Starting with, if you're new to these webcasts, welcome. It's great to have you here. But make sure that you're subscribed to our Trader Talks channel on YouTube. Pop down below the video, click on the subscribe button. It only takes a second to do that. Doesn't cost anything to do it. But our YouTube channel called Trader Talks Schwab Coaching Webcasts is where you can join these live streams, and you can find the playlists of the previous ones that you missed. So you can go to playlists as an example here. Scroll down through and look for investing in dividend stocks. I actually haven't looked, there it is right there. They move around a little bit from time to time, so I have to reorient myself. So this one, for this webcast series, is right there. Now, another thing that Brent and I would definitely suggest you do is to follow us on social media. So you can find Brent on X. His handle there is at Brent Moores CS. You can find me on X at Cameron May CS. And this is the place, social media, that's X or on LinkedIn, is the place to connect with me in between the live streams. So, for example, I noted yesterday that there was no Fed rate change. And I wanted to know what my friends on X thought about how the rest of the year was likely to go. Because it seemed to be Kevin Warsh was kind of hinting that there may be rate hikes coming in 2026. So what do my friends on X think? So far, seems that most still think that there's going to be no rate hike. We'll see. Now, you can also find Brent and me on LinkedIn. So for LinkedIn, you just go to linkedin.com/in, and then my handle is /Cameron May CS. You can just follow me here, and I post and reply on LinkedIn as well. So yeah, if you have the question, Cameron, where can I find you when you're not having a webcast? That's where you find me. All right, Eva. Yeah, we don't know, right? Eva expects maybe a 25 basis point raise. We'll see if that's what happens, Eva. But we'll see if there are future increases, how they might impact this portfolio of dividend stocks, how they might influence the bond market as it's sort of squaring off with the dividend stock market. I think it'll be an interesting thing to follow, along with adding to and managing our example portfolio. So guys, thanks for giving me your time. Go enjoy the rest of your day. We have lots of webcasts still coming up, so go enjoy the very next one. I will see you in a future webcast. Thanks everybody for all the thumbs up. We have 123 people still watching right now. 44 have already clicked the like button, the thumbs up. That helps. That's very much appreciated. It's not just applause to your presenter. It is that, but it's not just that. It also gives my video a nice boost in the YouTube algorithm, so more people can find these important discussions like, why is this portfolio lagging behind? Is there some metric that might help me solve that riddle? So guys, have a great day. I'll look for you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.